McGraw-Hill Ascent Audio presents The Millionaire Maker's Guide to Wealth Cycle Investing. Build your assets into a lifetime of financial freedom by Loral Langemeier. Narrated by Holly Adams. Introduction. The time has come for a new approach to investing. If you're willing to take action right now and take control of your finances, then you and I are having the same conversation. I can help you become a millionaire in 3 to 5 years. This approach is not only exciting and rewarding, but also empowering. Once you get into wealth cycle investing, you will be more in control of your financial future than you ever thought possible. Not only will you become wealthy, but your days will be more interesting and dynamic than you could have ever imagined. Best of all, through wealth building, you will improve every aspect of your life, and anyone can do it. Potential investors come in 4 types. Type 1 has nothing. This investor rents a house or an apartment, has a decent job that pays enough to break even after taxes, and has a little money in the bank, but has even more in debt, most likely on credit cards. This type is often caught in an endless cycle of making money and spending money. Type 2 has slightly more than nothing. This investor is similar to Type 1, but has also managed to put some money into an IRA and maybe some mutual funds. Type 3 has bought a house or an apartment and has some investments in the form of an IRA, stock market funds, or maybe a 401k. I find that most people who identify themselves as middle-class folk are of this type. Type 4 is the cash-poor millionaire. This type has $1 million or more tied up in underperforming, that is, lazy, assets. These assets usually consist of a primary home that's appreciated over the years, maybe a vacation house, 401ks, IRAs, and a fund or two. Despite their impressive net worth, cash-poor millionaires live month to month in the same endless cycle of make, spend as the other types. Perhaps you can identify with one of these types, or perhaps you are somewhere in between. Regardless of the type, too many people seem to be working very hard to build a financial life that ends up being a whole lot of nothing. And that's not okay. They need to be part of wealth cycle investing. The complete wealth cycle, which was fully explained in my last book, The Millionaire Maker, is a process in which income and assets are continuously created. The investing piece, which is the subject of this book, gets you to a place where you are making more money available for investing, learning about different investment opportunities, gathering a team to help you invest, and investing directly in the kinds of assets that will make you a millionaire. Millionaire-making assets are those that provide investors with higher-than-market returns, allow investors to hedge risk, optimize investors' energy, efforts, and money. Traditional investing alone may or may not make you wealthy. I don't know about you, but if I'm going to make the effort to invest, I want to get wealthy doing it. The problem is that when most people think of investing, they think of owning pensions, IRAs, mutual funds, and a primary home. Some think stocks, maybe bonds, insurance vehicles, annuities, and probably a second home. These are investments, it's true, but unless you're very lucky, these are not the investments that will make you a millionaire in a timely or sustainable way. If you want to be a millionaire, a real millionaire, not just a millionaire on paper, you need to go beyond traditional investment vehicles such as pensions, IRAs, mutual funds, home ownership, and stocks. Building $1 million portfolio requires the type of assets and strategies that the wealthy have always used to generate cash, grow their net worth. These assets include income-generating and appreciating real estate properties, private business ventures, and other such investments. Wealth cycle investing strategies include making more money, building more assets, structuring entities to benefit from tax laws, and leveraging OPM or other people's money. Many call this high-risk, high-reward investing, but I believe risk is only your failure to educate yourself about an opportunity. Much of the risk in high-reward ventures can be reduced if you collect enough information and put together a wealth team. The wealthy did not get that way by maxing out their 401ks. People whom I've helped educate have portfolios that include dozens of cash flow generating houses, exciting new startup companies, and even oil wells. That's right, oil wells. Not the stocks that represent the oil companies, but the honest-to-goodness dirty drilling rigs. This shift in your approach to investing can put you on the road to generating and sustaining great wealth in just 3 to 5 years. That's true no matter when or where you begin this process, whether you have underperforming investments, lazy assets, or you have nothing and are in debt. I was in the latter group when I made the decision to become a millionaire. At the time, I was sleeping on friends' couches and had no assets to speak of, let alone much cash in my pocket. I grew up on a farm in Nebraska, went to college on some scholarships and my own dime, and spent much of my life working hard for grades and money. In my teens, I created a health and fitness business and operated it through my college years and beyond. I was brought up to believe that you work hard for your money and then you retire. Looking back, that now reads to me as limit your life until you die. But that's the path I was on. Work hard for your money was my core belief. It was based on a childhood of that type of conditioning handed down from my parents, who got it from their parents, who got it from their parents, and so on. After college, I landed a senior-level job at a Fortune 500 company, and fortunately, my path changed when I met people who thought very differently about earning and investing. They were making money the way the wealthy had made it for generations. Instead of working at jobs with a fixed wage and an ultimate salary cap, they were creating their own companies, pursuing entrepreneurial ventures, and using that money to invest in and develop more assets. That was the secret formula of the wealthy, managing and building a portfolio that created even greater wealth. Eventually, I turned off that stay small and work hard for your money neon sign in my brain and decided to reach out for the bigger, better life I'd always dreamed of. I took charge of my wealth and made a commitment to become a millionaire. At that time, I owned nothing but my car and a small savings account. I was also pregnant and preparing to be a single mother. The commitment was prompted by a colleague who basically told me, "Single mothers can't be millionaires. It's too hard. You're doomed." Sick to my stomach with his decree, I became even more determined. And a few weeks before my 34th birthday, I became a millionaire. Even better, through investments and involvement in my business, my 7-year-old son, Logan, is well on his way to becoming a millionaire as well. I did all of this by creating and executing the wealth cycle, an approach that helps you accumulate wealth and have ready cash to enjoy a better life. The wealth cycle consists of 12 building blocks geared to creating wealth. These include entrepreneurship and entity structuring, as well as forecasting strategies, debt management, team building, and leadership. This book focuses on the building block of direct asset allocation, or what Wall Street calls DPP, direct participation programs. In the wealth cycle, we simply call them assets. My approach is not difficult. It's just different. All it takes is collecting knowledge and getting a team together to execute your strategy so that you are successful. Neither of these is that hard. In fact, the first step I took to accelerate my investments was a simple call. I picked up the phone and found a mentor who was investing in the type of assets I wanted in my portfolio. He helped me research that asset class, find the right deal, and put the team together to get the deal done. That is the approach that made me a multimillionaire fast. And it's how I continue to accelerate my wealth. I amass knowledge, and I get a team. this book explains how you can build your assets by dramatically increasing your access to cash, credit, and deal flow. You learn how to invest in diverse areas, ranging from traditional equity and debt instruments, such as stocks and bonds, to more unconventional money-generating vehicles, including private equity, oil and gas, and a variety of real estate ventures, such as land, multi-tenant buildings, and commercial properties. The objective of wealth cycle investing is to create above-market returns at below-market risk. Any investor can do this, and that means you. Whether you are a Type 1 who needs to make something out of nothing, a Type 4 with lazy assets that need waking up, or somewhere in between, you can supercharge your portfolio and create cash-flowing wealth. This book does not offer investment advice. Its goal is to educate you on how to create and build assets. Now you can do what all the other millionaire makers have done: invest directly in specific cash-generating and appreciating assets. Welcome to Wealth Cycle Investing. 1. All about assets. Jed Stone was a classic Type 1. Young and single, he had a decent job, rented a small apartment in a big city, and had accumulated significant credit card debt. In the first 4 months of his wealth cycle, we helped Jed to create an additional $1,000 a month of income, structure his tax strategies to retain it, build funds for investing, manage his debt, and start creating assets. The first investment he made was in real estate. He bought a small house that put cash in his pocket every month. Soon, Jed was leveraging his money with other people's money in order to begin investing in more properties and other assets. Allison Connor was in a similar boat. A Type 2, she had some money in her IRA and a mutual fund that she'd created right out of college. After meeting a mentor who bought and sold small businesses, Allison became interested in private ventures. Later, she bought a laundromat and invested in other businesses. With the primary home under his belt, Mick Buchanan thought he was in good shape financially. A Type 3, he had several mutual funds, an IRA, and money in his 401k. But his wife Mary couldn't understand why they weren't able to take a few vacations and ensure payment of their children's college tuitions. After working with me, Mick and Mary discovered, and then invested in, several assets, including private equity ventures that generated thousands of dollars of cash flow each month and increased their net worth. And then there was the Type 4 cash-poor millionaire, Dee Newton. Dee, a single mother, had more than $1 million in net worth, most of it as a result of the appreciation of her California home. She also had money in a stock market fund, a 401k, and IRAs, and money in the bank. Yet she never had enough cash at hand, and she had built up significant credit card debt to cover her monthly expenses. Proof that today's millionaires are like yesterday's middle class. Most of these cash-poor individuals are actually shocked when they find out that they have $1 million in net worth. Once Dee initiated her wealth cycle investing program, she was able to shift her lazy assets into cash flow generating investments, while, at the same time, building and accelerating her net worth. These 4 examples represent the classic types of investors I run into. In each case, my team and I were able to educate and train these individuals so that they could make more money, build their assets, and accelerate their wealth. It took time and effort and education, yes, but most of all, it took desire. I will show you how each of these investors built a wealth cycle and deployed a Millionaire Maker plan. You'll hear how Jed bought his first house, Allison invested in a small business, Mick bought into private equity, and Dee played in the oil and gas market. Wealth cycle investing involves direct asset allocation, also known as direct participation programs. Let me break this down. 1. Direct. There's no middleman. You seek out the type of asset you want to purchase,
and you put your money directly into that asset. If it's a commercial property, you put a team together and buy that property. Instead of owning an anonymous stock in some public company, you buy a piece of a private equity venture where the managers know you and you know them. You don't put your money in some fund or stock and hope for the best, what I call the park and pray model, where you park your money in an investment and pray that someone manages it well enough to earn a profit. 2. Asset. I recommend investing in hard, real assets that you can see and touch, such as properties, business ventures, and even private debt instruments. There is no limit to the range and spectrum of what qualifies as a high-reward asset. It takes creativity, resourcefulness, and initiative to find or develop these assets. With an experienced team and knowledge of the asset, you can minimize the risk associated with these high rewards. 3. Allocation. Diversification is an age-old investment strategy that works very well. It's important to include diversification in any approach to wealth building. In wealth cycle investing, you allocate your assets across many different classes and types with various growths, yields, locations, teams, and time frames. Direct asset allocation begins with a plan. To create and execute this plan, you must know your investment criteria. These are your money rules. Get your cash ready for investment by converting lazy assets into cash, making more money. Scout opportunities. Collect knowledge. Put a team together because someone has done what you want to do. You don't have to reinvent the wheel. Other people's experience lowers your risk. More help means more speed by flattening the learning curve. Pursue field partners, experienced professionals who act as point people, provide access to the direct asset investments, help manage the asset. Conduct due diligence. Make decisions and take action. Investing to create real wealth requires action and the pursuit of higher-than-market returns. Risk is continuously minimized through knowledge and a team. By consistently managing risk through knowledge and a team, the wealth builder can venture into more rewarding deals and investments. Historically, high-reward deals were reserved for the wealthy, but wealth cycle investing creates an opportunity for anyone to become wealthy. Accredited or not accredited, that is the question. In the past, the best investments, those with the highest returns, were reserved for accredited investors. These are investors who already have a high income or more than $1 million in net worth. Originally, this barrier to entry was established to protect those who had little to lose from losing it all. But to me, it seems that the practice did just the opposite. It made investing solely the playground of the rich and left those with little money with no skin in the game. People who wanted big returns had to wait until they met the minimum financial requirements established by the Securities and Exchange Commission, SEC. While it's an interesting political comment to say that the rich get richer and the poor get poorer, the truth is, the rich and the poor aren't even having the same conversation, let alone accessing the same wealth building and tax strategies. The investing opportunities that await those who are considered accredited investors offer much higher rewards than those that are available to everyone else. That's why when you engage in wealth cycle investing, it's important for you to reach accredited status as soon as possible. The good news is that the term accredited investor was defined by the SEC in 1933 during the Depression, when the dollar, and certainly $1 million, had a lot more value than it does now. In fact, according to the Consumer Price Index, CPI, conversion factor, $1 million in 1933 was equivalent to almost $15 million in 2005. Yet, the definition of accredited investor remains. 1. You and your spouse have $1 million net worth, or 2. You have an income of $200,000 yourself or $300,000 together. Or 3. You represent a trust with $5 million in assets. Again, that's not as daunting today as it was in 1933. There are many who would not consider themselves wealthy who have $1 million in net worth. Of course, to many of you, these numbers are daunting. Wealth cycle investing helps you work your way toward them so that you can eventually accelerate your investments and get in on the high-reward deals. There are smart financial planners, brokers, bankers, and fund managers who know that this model is the way investing will be done in the future. No matter who you are, you can bring something to the table. Maybe it's money, maybe it's credit, maybe it's ideas, maybe it's experience, maybe it's people, or maybe it's your time and energy. All these things are valued by the financial community. The importance of being an accredited investor can't be emphasized enough. If you are accredited, you are eligible to invest in more direct asset allocation opportunities. When I work with people who have little in the way of assets, income, or anything else, but who want a quick acceleration of their wealth cycle, I suggest that they put together a team, make more money to qualify for accreditation, and do that by first getting in on diversified, high-risk, high-reward deals that don't require accreditation. Get a team. Smart investors build and work closely with a team because having a team reduces risk. By gathering a team of mentors, whether industry professionals, colleagues, or friends, you can efficiently collect information and knowledge, enjoy the advantages of other people's experiences, hear about new deals, gain access to deals, leverage your money or credit with other people's money or credit, further diversify your investments. And that's just the beginning. Seeking and finding the best professionals in your asset class, gathering like-minded peers with whom you can join forces, and hiring the support you need to make the best use of your time are all essential to building assets. Building a team makes sense, and it's not that difficult. For example, if you're involved in a lucrative real estate deal, you'll need a good lawyer. You'll find one by calling people who have done large real estate deals and asking for recommendations. You don't have to know these people personally. You just have to have the confidence to pick up the phone and ask them a question. This is one of the many action steps that wealth building requires. If you're shy and nervous about taking this step, that's okay. But don't let your fear stop you from moving forward. Make the call. It will be easier the second time and a walk in the park the 10th. Make more money. If you don't meet accredited investor status, you need to find ways to make more money. Look at your current assets, if any, and figure out how they could perform better. Then consider your skill sets and devise a business venture. In the wealth cycle, this is your cash machine. The cash machine is not a dream business, but a practical money-making operation that will start generating revenue immediately and is pursued in conjunction with your current job. For example, I suggest that teachers start a tutoring business on the side, or that a craftsperson consider selling his or her furniture on eBay. Additionally, I suggest that you structure entities, such as corporations or partnerships, around these businesses to support tax strategies that allow you to retain more of your income. By making and retaining more money, you can begin to fund your wealth account and accelerate your journey to becoming an accredited investor. Start with deals you can do. There are investments and deals with higher than market average returns that do not have accredited investor requirements. Real estate is one area where there are opportunities for those who have not yet made their million in net worth. There are many properties that can generate real cash and provide quick growth. Real estate is a great way to work your way toward the accredited investor requirements. From there, you can get into more lucrative deals. There are also ways to get in on the deals that do have accredited investor requirements even if you're not yet accredited. The SEC allows privately placed investment opportunity to offer up to 35 non-accredited individuals ownership in the venture. Many of these investment opportunities are put together by entrepreneurs and small businesses through private placements. While there are deal managers and entrepreneurs who won't even talk to unaccredited investors, there are many more of these small business ventures that are legally allowed and willing to let you in on the deal. Of course, you'll need to research these small business ventures carefully, just as you do any direct asset allocation deal, big or small, in which you can invest. Your team can help you find these. Moving up to a bigger life. Making the commitment to pursue a bigger, better life takes strength and self-confidence, absolutely. Your conditioning, those messages you've absorbed since childhood, might need to be upgraded. You do have wealth-building muscles. They're just atrophied, and we're going to pump them up. What you need to understand is that everything I'm sharing with you in this book is doable. What you need to do is make the commitment to live out loud when it comes to money, to be open to a new way of thinking about and approaching your finances. When you live out loud, you say what you want and take action to make it happen. This is the best approach I know of for ultimately getting what you want, and it's why I named my own company Live Out Loud. Wealth cycle investing takes you to your want-to life and away from a have-to life. It allows you to differentiate real risk from perceived risk and reap the highest rewards. Somehow we've spiraled into a permission-based society where people sit and allow others to control their fate. They settle into a routine, do things by rote, and work hard to get an A. In wealth cycle investing, you control your own life. The ideas that I share here are based on an educational platform that I have used to create millionaires. I want to make it very clear that these ideas do not reflect my portfolio or suggest what yours should be. When you engage and initiate the wealth cycle investing approach, you are responsible for your own wealth. Investing is personal, and the choices you make must be in sync with the needs of your current situation, your financial objectives, your vision, and your values. I know people who invest in real estate, oil and gas, and stocks. I also know people who only like laundromats or video arcades or mobile homes. Others who put their money in other people's businesses, and still others who prefer purely passive investments such as promissory notes and private equity funds. I always recommend an asset allocation strategy that has a diverse, carefully chosen blend of assets in which you have direct control of your investment. The allocation itself is up to the individual. That's the point of being in control and leading one's wealth. When you decide to initiate and develop a wealth cycle investment portfolio, you absolutely must do your research on each and every investment. Continuously improve your financial awareness. Seek expert advice on each and every investment. Build a team to maximize capacity and minimize risk. Never park and pray, but always control your own money. Live a corporate life with tax advantages managed through entities. Stay in motion, because wealth takes action. Sequence. Do the right thing at the right time, every time. Work toward building a bigger, better life. Live out loud to learn, teach, and help others. Assets to assets to assets. Good investments go beyond pensions, 401ks, IRAs, stocks, bonds, mutual funds, insurance vehicles, your primary home, and even your second home. Here's what I look at. Land and pre-development deals, rental properties, commercial real estate, energy and natural resource development and production, such as oil and gas, new product development, private business ventures, coin-operated retail businesses, warehouses and distribution centers, original equipment manufacturers, private money, or debt.
Sample complete. Ready to continue?